Okay, let's dive right into this. We've all seen how AI has just completely exploded in the financial services world. It promises unbelievable speed, massive scale, but, and this is the big but, in a high-stakes world like finance, that very same power, when it's left ungoverned, well, it creates a massive, almost invisible risk.
So it really forces you to ask this one critical question. Is your AI a powerful asset that's driving your business forward, or is it actually a ticking liability, just sitting there, waiting to cause some serious reputational, regulatory, and, yeah, financial damage? As we're about to see, the answer to that really comes down to just one thing: governance.
And this is where you see the real double-edged sword of AI and finance. The very things that make it so incredibly promising, the speed, the scale, the efficiency, are the exact same things that make it so dangerous. I mean, think about it for a second. That speed, it can hardwire a hidden bias into millions of decisions in the blink of an eye. That scale, it can blow up a single tiny risk across your entire portfolio in minutes. And that hyper-efficiency, well, that can lead to some massive regulatory fines if you can't explain how your models are making decisions.
Right, and we have to be super clear about this. Finance isn't like other industries, it's not e-commerce or social media. When we're talking about AI here, the stakes are on a totally different level.
We're not talking about a misplaced ad or a bad song recommendation. We are talking about highly regulated decisions that have a real, profound impact on people's lives. We're talking about AI models that are approving or denying people loans, flagging legitimate transactions as fraud, or deciding what someone pays for insurance. These aren't just abstract data points. These are major life events for your customers, with their financial futures hanging in the balance.
Okay, so if we're going to get a handle on this, we've got to break it down. We need to really understand the anatomy of the risk itself. When an AI that's just running wild makes these kinds of high-stakes decisions, where are the weak spots? Where are the core vulnerabilities?
First up, and this is a big one, is model bias. This is what happens when an algorithm, which is often trained on messy historical data, ends up making systematically prejudiced decisions against a certain group. And let's be clear, this isn't some tiny technical glitch. This is a direct violation of fair lending standards, and it can lead to huge regulatory penalties and brand damage that lasts for years.
Next on the list is something called model drift. Look, the world doesn't stand still, right? Things are always changing, and that means the data your model was trained on is eventually going to be out of date. So, without constantly keeping an eye on it, a model that was perfectly accurate last year can quietly, or sometimes very suddenly, become a huge liability, spitting out flawed predictions that put your whole institution at risk.
And this brings us to what might be the biggest headache for any compliance team, the explainability gap. You've probably heard of it as the black box problem. So what happens when a regulator calls and asks why a customer was denied a loan? If you can't give them a straight, clear answer, you've got a massive problem on your hands. The rule here is simple. If you can't explain it, you can't defend it. Period.
Okay, so we've laid out all the scary stuff, the risks. So what do we do about it? Let's flip this around and talk about the solution. This isn't about killing innovation or slowing things down. It's about building a smart, strategic framework, a governance blueprint that lets you scale AI safely across your entire company.
Look, building a framework that can actually stand up to scrutiny really boils down to 5 core steps. First, you need an inventory. You just can't govern what you can't see. Simple as that. Second, you have to classify the risk of each model. A simple marketing model is not the same as a high-stakes credit underwriting model. Third, you need a formal approval workflow to vet these things before they go live. Fourth, make sure there is meaningful human review in the loop somewhere. And finally, step 5, you have to have continuous monitoring to catch things like bias and drift before they spiral into a full-blown crisis.
So let's pull back for a second. What does all this mean at a higher level? Well, it points to a brand new operating mandate, really. It requires a fundamental shift in how the entire organization, from the top down, thinks about AI.
And this quote, this just nails it. The days of playing around with isolated AI pilots and science fair projects are over. To really scale this stuff and get the true value from AI, financial institutions have to move from just doing ad hoc projects to building a comprehensive, defensible operating model for AI across the whole business.
And if you remember just one thing from all of this, let it be this. We have to stop thinking of governance as a barrier. It's not a roadblock. It's not a checkbox exercise. It is the exact opposite. Strong, smart governance is the enabler. It's the launch pad that gives you the confidence to deploy AI safely at a huge scale, unlocking its real competitive advantage while protecting your company and, most importantly, your customers.
So, I'll leave you with this question to take back to your teams. It's not just about whether your AI model works right now, today. It's about whether it's built on a solid foundation of governance that will let it perform safely, ethically, and effectively for years to come. So ask yourself, is your AI model really built to last?